I can.
I'm willing to call the meeting to order.
All right. Thank you, Bert.
This is a meeting of the town of Simsbury's investment, the retirement plan subcommittee. I see that the first item on the agenda is the appointment of a chair, a vice chair for the coming year. Also, to set up the regular meeting schedule, could I have a motion to table those agenda items until our next meeting?
So moved.
Second.
All in favor? Aye.
Aye.
Any opposed? The motion passes unanimously. We have two sets of minutes to approve. I'm not clear on it. I read the minutes, and the minutes for September include approval of the minutes for May. So I'm not sure why both of them are on the agenda. But in any event, does anyone have any discussion, or has anyone found any errors in the minutes that were circulated?
Yeah, on the September 5th, the list of attendance, it's got me as Board of Finance, and I was on the Board of Ed at the time. So.
Anything else? So could I have a motion, please, to approve the two sets of minutes subject to correction of Todd's title as of September 5th? It's a very passive board today.
I will move that.
Is there a second?
Bert, you need to second. You're the only one who is there. Everyone else probably has to abstain.
Yes. Right. So as someone who wasn't present in September 5th, I'm not going to vote, but could all who were present and who wish to approve the minutes for the meeting, all in favor say aye.
Aye.
All opposed? I abstain. And the motion passes. So now we're ready to proceed to the real business of the morning and get a report on our pension plan and OPEB trust for the third quarter.
I think that's me. I'll get started.
I believe so.
Thanks, Bert. Good to see some familiar faces. For Heather and Steve's edification, just quickly, Chris Cashmar from Fiducian Advisors, joined by my colleague Tyler Polk. We have been long-standing advisors to the town's retirement plans. We help you with investment advice and fulfilling your other fiduciary obligations, and have had a great working rapport over the years with the town. So delighted to see some new faces and hear some new opinions and input along the way here. I'm going to bring up the deck, but just as a matter of order and organization, it's obviously a lengthy deck for those of you who had a chance to look through it. As always, we'll confine our comments to just the highlights to keep things on track. Start a little bit with just generally what's going on in capital markets. We'll get you caught up there. We'll talk a little bit from a governance perspective. This quarter on my side of the ledger, we've got some data to share with you in terms of trends statewide on the return assumption, the discount rate assumption front, and funded status trends as well for pension plans. And then we'll obviously look at the performance quickly of three of the pensions and the OPEB trust. And then we'll segue over to Tyler to give you a quick update on the defined contribution platform. The one thing I would mention on our side, just to get the group caught up, we are in the season right now, literally this week and next, of finalizing our capital market assumptions and our forecast for 2024 and beyond. You'll remember once a year anyways, we rerun your portfolios through our software, and that gives us guidance around around the larger allocations of the programs, the configuration and composition, if you will, of the portfolios underneath the hood a little bit, and kind of gives us a checkpoint to see if we're still in good working order in terms of meeting the objectives that you've set forth for the different asset pools. We'll share that lots of collateral with you on an interim basis. We'll get that off to the town, year-end outlooks and the like. But at our February meeting, we'll have the benefit of that full work product, and we could we will work through that with you to give you those assurances. So that was a little bit of a long-winded introduction, but just giving some new faces, hopefully an appropriate and useful one for the board. With that, I'm good. Bear with me here. I thought I had Tyler. Can you pull up the deck quickly or no? I don't.
Yeah, I wanted to kind of place the order today, but the office said, down the other day, but the office wants another 50K draw since the FEMA stuff hasn't been paid yet. And we gotta pay the deposit on the cabinet, and then I have to pay the fine.
Lee, could you mute?
And we just pay.
I don't know why, I don't know why they're taking so long to pay, but like the office won't let me.
Thanks, Kelsey.
I don't want to compete with town business.
Right.
So I'm gonna keep my mouth shut.
We're seeing how the sausage is made.
Oh, it looks like Kelsey was able to get that. Could we go to page 5, Tyler, quickly in the deck? I think it's just the big picture. There we go, right there. So this is a busy page, of course, and we won't dwell on it for too long. The takeaways are pretty simple and straightforward, starting with the fact that, as you all know, markets have been a bit of a hostage to what the Fed's intentions have been and messaging have been around interest rate policy. We think that they're largely done with their austerity campaign, and that rate hikes are done. And if in fact that's the case, we thought it interesting to look back through time, previous campaigns, and see what transpired in capital markets on a go-forward basis. Look at the chart in the upper right-hand corner of the page that Tyler's got there. You can see 3 or 4 or 5, I guess, previous campaigns, and you look for both equities and fixed income, and you actually get pretty constructive outcomes, right? So our premise is that we may have a bit of an economic slowdown forthcoming, but if they're able to avoid a hard landing, and markets seemingly think that that'll be the case, the pathway through to more stable and consistent returns from some of the volatility we've seen more recently might be achievable. So that's just a perspective for the committee. Again, nothing to act on. The other interesting thing that may require us to act when we get together in February, as I previewed on the allocation front, look in the lower left-hand corner of the page. We ran for an extended period of time where earnings yields were significantly higher than fixed income. You'll all remember we had historically low interest rates for an extended period of time. That is not the case anymore. You see in the far right of that graphic where earnings yields and fixed income return yields, have started to kind of coalesce there and are very close to parity. Think about just from an allocation or a construction standpoint with a basket of assets, right? If there are pretty compelling nominal yields available in the fixed income markets, it may have implications for the mix of assets that we need to support the needs of the programs. It could mean, we've got to prove this, right? But it could mean that we can get away with a little bit more fixed income and less in the way of equity, and not sacrifice the return potential of the program. So something maybe just to kind of put on the shelf, if you will, mentally in preparation for our February meeting. And then finally, inflation, certainly in fairness to the Fed, right? We had headline inflation 9% plus last summer. We are now down into the mid to upper 3% with the headline prints that we've seen. So they have certainly, to their credit, made a lot of headway on the inflation front. And I think, again, that headway and momentum they've had, in some ways, we think supports the idea that maybe they're done with having to do anything further, and they're going to let these, hikes kind of season into the marketplace a little bit, and have maybe even a modest further reduction in inflation. So those are big picture themes. If you jump, Tyler, 2 pages ahead, just on the return page, the exhibit here, yeah, this one is good. Let's spend 30 seconds here. So in kind of an interesting year, right? If you look across the top half of the page, the third quarter was a challenging one for capital markets, both for fixed income and equities. Certainly the principal kind of headwind for both were higher interest rates, materially higher interest rates, which front and center, as you know, is a headwind for fixed income total return. But it also kind of permeates the equity markets, because you get, re-rating of assets and revaluation of assets, and higher rates, right, can be penalizing, all else equal, for kind of corporate financial performance. So we had a down quarter. You see there, we're not going to go through all the numbers this morning, but you see about down 3% for both equities and fixed income in Q3. And we'll see how that flows through the portfolio momentarily. Not on this page, but it'll be interesting, and we'll run numbers and share these with the town as we come into year end. October was actually a bit of another down month, but November was an absolutely spectacular month, as you've probably read in capital markets. Global equities were up 9%. The bond markets were up about 4.5%. It's the biggest monthly return in 30 years in the bond markets. It does speak to the volatility that we've seen, right, and talked about. And as we always talk about, the best first order of defense against that volatility is diversification in your asset pools, which obviously you've ascribed to for a long time, and it's worked to our advantage over time as well. So that is a big picture market update. Anything from the committee, just big picture generically, before we segue over to the performance review? Folks have any questions? Folks okay? Just dive in, obviously, if something doesn't resonate. Happy to stop and redirect our comments. Could you go, Tyler, to page, I'm going to jump all the way ahead into the Gov collateral. I think it starts on page 19. 19, 20, and 21, right? So we've got a standing 6.5% return target for the 3 pension plans, as you all know, and you've got funded statuses somewhere in the 70 to 80% range based on the asset pool. So that's just the data that you all know and are familiar with, but we thought it would be interesting if you jump, Tyler, a page or 2 ahead, to show you just where you compare to the state averages for what it's worth. I think it's that page ahead right after. There we go. So you can see, interestingly enough, at the top of the page, the median return expectation statewide is about 6.5%, right? Just about where you reside. So I think you're in pretty well stead, if you will, versus statewide averages. I think the other thing maybe of greater interest to the committee, other than the absolute level of the return assumption, and again, we'll retest that when we run your portfolios in the next couple of weeks, is just the noise and the conditioning around the direction of rates, right? Because you've been getting beaten over the head as a committee for years now to reduce your rate, right? I do think we're certainly in the mindset, and I've heard these mumblings from the Milliman folks and other actuaries as well, that most feel, given what's going on, particularly with interest rates and how rapidly they've moved higher, that trumpeting of going lower on rates can stop for a period of time. I don't think you're going to hear from Milliman that you have to do anything with your discount rate this year. So yes, Lisa.
We completed an experience study, and the actuary did say we were good at 6.5.
Oh, okay. So Jen did already confirm that. Okay, good.
Unless there's an update after that, but that was, I think, last December. I can't remember, actually. It was last December, but she was comfortable where we were at that point. So there may be a yearly adjustment, but.
No, if anything, I don't think anyone's talked about this, right? But I think some of the work in the capital market front I hate to say this right out loud, but I will, could even maybe support a higher discount rate, quite honestly. I'm not sure that committees like yourselves and towns are necessarily prepared to reverse the momentum you've made on lower rates. But certainly to your point, I think staying the course on the 6.5 is fully justified from what's the conditions in the markets and our expectations. So,
Chris, if we do that and perform better, that will help with our funding ratio as well, correct?
Right. Yeah. If you outpace your return, yeah, right. That's exactly, Lisa. Yeah. So I think you're in pretty good status there. And then the next page, I think, Tyler, just quickly, just funded statuses, and you see their statewide average, if you can make it out in the first bullet on the top of the page, about 72% or so. And we talked about, right, your three plans are comfortably in that range, you know, anywhere from 70 upwards of 80%. And you can kind of see the constituent breakdown down in the graphic there on the bottom half of the page. But certainly you're in good working order and common company, if you will, from a funded status standpoint. So actuarially, for what it's worth for the committee, right, I think you're in good working order and consistent with what we see elsewhere. And we don't talk about it in this study, but I think the question's been posed by the committee in the past. It doesn't explicitly control for asset allocation. But as we've talked in the past, you'll remember your allocations are very typical for what we see for mature plans, right? Kind of that balanced total return where you've got, 2/3, 65% in equities and the balance in fixed income, for example. So no concern from our standpoint on either of those or any of those three fronts. All right, so that's governance. If we could, Tyler, skip ahead to bear with me here. I've got skip ahead. We'll start with on 26. I think it's the town plan. So you'll remember this is the dashboard summary that you're hopefully the committee's grown accustomed to seeing. So a positive year-to-date and one-year number, a little bit of a relative shortfall. There are a couple of managers that have had tougher years. Western comes to mind within fixed income. There's been a little bit of pressure for some of the international equity managers. Bearings, as you know, in the real estate arena, like their peers, continues to redeploy capital away from some of the problem areas, and that continues to be a work in progress, but I think they're making a headway there. So nothing that really quells up in terms of an immediate concern from us from a return standpoint. You see the longer dated returns there generally align with the broad markets. I would say, and you don't see it here, but just as a reminder for the committee, this does come on the heels, right, of very good calendar years for all three of the programs in 2019, 2020, and 2021, when the portfolios all outperformed the broad markets. So we are on the heels of a nice run. And invariably, as you all know, right, we're going to occasionally have a step back toward the markets and as managers kind of recalibrate their positioning and whatnot. So nothing wholesale that concerns us from that standpoint. If you would, but I do have one last thing just to mention before we transition over to the other programs. If you could go, Tyler, to the next page. Here's the allocation schematic for the town plan. And as you all remember, right, this is the same allocation and manager schedule that the police and the Board of Ed plans share. We do have MetWest on watch, and we have done a lot of work on that complex. In fact, we had a team in Los Angeles about 2 weeks ago meeting with their counterparts at MetWest, the folks who actually are deploying your capital. We are in kind of live conversations with our research team as we come into the calendar year about their conclusions around MetWest and that watch status. And if there's a need or a requirement or desire to recycle that capital. Again, it's not a situation that we have to address this morning, but I just wanted to make the committee aware that we're very mindful of what's going on in MetWest. There have been some changes there, and in February, we'll be prepared to deliver that more detailed analysis to you and a recommendation if it's applicable. And then Newberger Berman, your small cap active domestic equity manager there, you see in the middle of the program, the page, excuse me, has had a pretty strong run until the last, actually the performance-wise, excuse me, continues to perform pretty well. We do have a retirement on the PM team. One of the women who started that strategy, an individual named Judy Vale, is stepping aside to an advisory role next year in 2024. They've built a very strong, competent team. We think that'll continue on with their traditions, but Judy was very important to the effort, and so we have a discussed status there. Again, nothing for the committee to act on, more an awareness that there is something we're monitoring with kind of an additional lens, if you will. The balance of the roster from a manager research standpoint, all kind of in good working order and position and performing, consistent with expectation, right, when you factor in the investing backdrop. So those are the highlights there. I would maybe quickly, Tyler, the story is the same, right? And the numbers obviously rhyme with what went on that we just saw. So the Board of Ed plan here.
Sorry, Lisa, do you have a question?
Oh, sure.
Yeah, just a quick question. Tyler, you, if we were to, for the minutes, if you were to project what our year-to-date investment return is, our target is 6.5. Where do you think we're going to come in?
So that's a good question, Lisa, right? So we were at 3 year-to-date through September. November was a little bit of a backdoor, right? We probably moved a little bit closer down year-to-date towards a slightly positive number. I think in the month of November, haven't seen the data yet, but I think the plans are probably up 6.5%, 7% in the month of November alone.
So what does that do to year?
I think when you piece it all together, you're on the calendar year basis, you're probably at the end of November in line with your targeted return. Would be my best guesstimate. We'll have that flash reporting in the next week and a half, 2 weeks or so. We can share that with the town. We can, get it over to Amy and Kelsey if you'd like and share it with you. So I think at least the short answer is, I think we're close.
We're about to go into budget discussion, so it would just be helpful to know what we're projecting on that. That
Sure.
would be great. Obviously,
let me make a note. We'll run the November flash. We'll make it. I'll have the November flashes run, and we'll get that information out to you. But I think we should be in relatively good shape versus your stated target.
Excellent.
So the Board of Ed plan here, again, right, I'm not going to dwell on it in the interest of time, but kind of the same representative performance and the longer term, track record kind of aligned with, I think, our longstanding expectations, what we've grown accustomed to seeing. The next page, Tyler, is, of course, the schematic, and this looks like you would expect, right? It's pretty darn close to the balances that we've got in the town plan, and obviously those statuses for the two managers carry over. Police, more of the same, right? From a performance standpoint. It's interesting. I'll just stop, maybe Tyler, just stop there just because I mentioned it. I know the numbers are small, but if folks can make it out in the middle of the page there, you can see there kind of the rolled performance, calendar year performance for the plans. And I mentioned, right, look down there, 2019, up 18.9, 2020 up almost, what is it? Boy, those numbers are small, Tyler. Was that 11%? Oh, 13%, 14%.
12.9.
Yeah. 2021 up 11.2, right? So we are on the heels of a pretty strong relative performance and absolute performance for the plan. So again, right, an assurance from our standpoint that I think things by and large are in good working order. The last thing I'll mention on performance, and we won't go through it unless there are questions from the committee. We track, kind of running tallies of the individual managers and their performance versus respective benchmarks. I think if you go back and look through time since, and your active managers, I think we count 8 of them in the program. 6 of the 8 are ahead of in line with their respective benchmarks since their respective inceptions. I think that is a kind of a testament to most of the managers, most of the time are contributing, and we know that's not an absolute right statement, that there will be times like we've seen more recently where you can get a small measure of underperformance in market recalibrations. But a batting average at 75%, if you call it that, 6 of 8, we'll take that all day, right? I think that's a good testament to that you've got a good mix of active managers. So more to come on Met West, more to come on Newburger at our February meeting. And most importantly, again, be prepared, if you would, for an asset allocation discussion and kind of where we stand with the benefit of our latest inputs. Quickly on OPEB trust, I think it starts on 54, Tyler. Yeah. So remember here, no changes and no recommendations. I think I'll maybe, Lisa, ask you. I know Jen mentioned there's some conversations going on with respect to the OPEB trust and funding and paying out claims and that kind of thing. I don't think anything's been concluded on that front from my understanding, but she hinted that those conversations are forthcoming maybe?
I don't have any information on that. Kelsey or Lee, can you update us on that?
And I could
I can provide you an update with that. I'll shoot out an email.
Yeah, I could be speaking out of turn, maybe, Lisa. I thought Jen had mentioned that I think we're going to be working with the town on just the way that the plan is kind of administered and how we source funding and that kind of thing. Again, I don't think anything obviously has happened because you folks haven't approved it. I thought it might just be a forthcoming conversation. The takeaway from us is that there's no immediate action needed, right? So this portfolio, you'll all remember, is fully indexed. You see the performance there, net of fees, right? As we've talked in the past, we're using ETFs. Short term, over a quarter or two, you can get a little bit of variability in return based on the way that those ETFs trade. You see there over the long haul, you get what the market offers, right? Which is by design. And then I'll stop on the next page, Tyler, if you would. Thanks. You just see the collection of the ETFs and again, right, while indexed, diversified nonetheless, right? So we've got fixed income and we've got different slices of domestic and international equity, a little bit of real estate to diversify the program. And, the other thing I would mention that is, and I just as a credit to the town to stop with it, obviously from a funded status standpoint and just the sheer amount of assets that you have dedicated to your OPEB liabilities, you are way, way, way ahead of most of the state, I think, as you all know, right? You've made a very concerted effort there and a commitment to it. And the progress you've made is pretty remarkable. I can only think of one or two other towns that are even close to what you've done here in terms of getting this up and funded and running. So kudos to the town and the committee. But no actions required on OPEB from our standpoint. So that's pension, that's OPEB. I think that's probably my allotted time, Mr. Chairman. And absent any other questions, I'll cede the floor to Tyler.
It looks like Heather has a question.
Oh, okay, sure.
Hi. So looking ahead to February, when you had mentioned that we may kind of shift the 2/3, 1/3 and move a little more towards moving the 1/3 fixed income up, is there, how far would you adjust that? Do you keep a parameter within that?
Yeah, we've got a couple of things, Heather, right? So one of the things we would have to dust off, right, the investment policy statements themselves for the plans, right? We need to be mindful of the ranges that are embedded in those, but they're pretty wide. I would tell you as a preview, and I don't have the numbers just yet, it might be a fairly modest move. Maybe 2.5%, maybe 5% of equity to fixed income, something like that, just on the margin to recognize the higher interest rates that you can enjoy now. It wouldn't be a dramatic shift or a dramatic overhaul. It would be a marginal one.
Great, thank you.
Could I just ask a silly question? Why the pages of the deck that was distributed before the meeting don't line up with the ones we're seeing?
Yeah,
on the
that's
screen
that's
now?
my, sorry, Bert, that's my fault. it was easier to scroll using my deck
Oh, I see.
as opposed to the other one. So I pivoted. It was about a page off, so I'm happy to correct it as we go along.
No problem. Thanks.
Anything else on my side? Doesn't look like it. So I think Tyler, you've got the floor on the DC stuff.
Sure. I think I'm a page off. So it's I'll start on 41, which may be 40 in the other deck. But just so visually you could see it a little better. For the new folks,
It was a page off for most of it, and now it's totally askew.
I don't think the OPEB was in what we got.
Yeah, it wasn't. Okay, so actually, you're at page. I'm finding it now.
I can work off of this as well.
Oh, the OPEB stuff is I just found it on page 55.
Yeah, again, apologies. It was just easier to scroll.
Yeah, no, that's okay. It's easier to read off the deck we got. So you're starting at what looks like.
I'm starting at your page 70. Yeah. I'll work off this one. That's fine. Just for some of the new folks and Heather, great to meet you. This is what we call our governance calendar. So, again, because this is a participant-directed defined contribution plan review, we're always going to review the investments, but each quarter we focus on something slightly different. This is a focus on the participants. So we give you a brief record-keeping update. You're using Mission Square as a record keeper, being that they're keeping obviously the records, the statements, the call center, the websites. We talk a little bit about plan design, and then what is available to participants from an education advice standpoint. So I'll touch a little bit on that, and then as you can see throughout the year, we pivot, and last quarter we spent some more time on the types of funds being offered, and we'll revisit fees first quarter, which again, we were able to greatly reduce through the RFP process a year plus or so ago. So I will go through this in good order. The one thing I want to briefly touch on, so flashback to same time last year, Secure 2.0 was passed. There were 92 provisions impacting retirement plans. Many of which were optional provisions, a few of which are mandatory provisions, and so over the next year, I'm happy to assist with the group on what potential optional provisions make sense. Again, there's no requirement that you add any of these provisions, but they're provisions like giving participants access to distributions if there was a federal disaster, a federally declared disaster, or if they're victims of domestic abuse. There's a few other provisions around potentially receiving employer contributions as a Roth contribution as opposed to a pre-tax contribution. There's some mandatory provisions as well. There was a delay in people's requirement or minimum required distribution. So typically you have to take money out at 72. It used to be 70 and a half, if you remember. They're bumping that up to 75 over the next 5+ years. So changes that will be implemented, some automatic, some we'll revisit. One big provision, if you recall, people are allowed catch-up contributions. So the core contribution that people are allowed to save in, say, a 457 plan is $22,500. If you're older than 50, you can save an additional $7,500. The Secure Act actually applied salary to that catch-up contribution, and if you made more than $145,000 in the prior year, the catch-up contribution is required to be Roth. That's across all plans. The challenge was administering this, and I think the federal government understood that after they decided on this provision. So I think for the next 2 years there'll be a grace period, so you don't have to implement that until 2026. So we have some time to figure that out, but it does add some challenges because now you have to track people's prior year salary and when allowing for catch-up contributions. So more to come on a lot of that. On page 72, trickier to, so what I've put together here is both a benchmarking of investment offerings as well as a benchmarking of plan design. Now, with municipal plans, it's a little trickier to benchmark plan design because obviously there are variable plan designs depending on collective bargaining units. So I'll touch on a few things here. The good thing in the 457 plan is you are allowing for Roth, which is great. You do allow for loans, which you can see majority of plans do offer. On the top part of this chart, what's offered to plan participants, obviously you have around 18 investment options. You're allowing people to get advice, which is not mandatory, but you are, and you can see majority of plans do offer advice. You are also allowing for managed accounts, and I'll touch a little bit on managed accounts as well. So you do allow for people to have their accounts managed per various risk profiles and various balances. And then, of course, you offer target date funds to the plan. I did the same benchmarking on the 401A. Again, that's the employer tied contribution structure. You get an idea of what vesting looks like and the comparative vesting structure and other plans. And so no clear recommendations. Again, you're offering this Roth structure. What we have seen more and more is something called auto enrollment, where you're automatically, as you hire individuals, you're automatically deferring them into the plan, and they have to elect to not contribute to the plan. You don't have that in place, but we're seeing more and more 401k plans and 403b plans move in a sort of automatic structure. The idea behind that is if you do nothing, you're in a better place than if you acted, right? So again, more to come on this, but definitely a direction that we're seeing. The one record keeping service update that we did provide for you is, again, given that Mission Square, your record keeper, collects and holds employee data and obviously employee assets. The DOL did provide guidance around what you as fiduciaries should do to monitor cybersecurity. And so we work with not only Mission Square, but 22 other record keepers, the Fidelities, the Schwabs, the Vanguards of the world. And so what we did on your behalf is sent out a questionnaire around cybersecurity to not only Mission Square, but all the record keepers we work with. And again, we're not a cyber firm, but we can evaluate anomalies and other things that come out of that questionnaire. And so I'm gonna it's in the appendix, Bert. I'm just going to use this so I can scroll quickly, but I won't go through all of the sections of the appendix. But just note in the back of this deck is the results of that questionnaire around cybersecurity. And what we're asking for is, again, were there any breaches? What kind of training is in place? If there is if there's fraud, are people made whole? And is there multi-factor authentication set up? All of these things were answered in the affirmative with Mission Square. We don't have any concerns. There weren't any breaches that we were concerned with, or any breaches that were significant, obviously. But again, I will note this is occurring in this industry. There were a few third-party providers, and this is not tied to Mission Square, but there were a few third-party providers breached over the last, call it 6 months. There was a third party that TIAA used to track mortality that was breached, and data was leaked, and obviously people were provided with credit protection. And there was a third party that worked on non-qualified plans in the corporate space, and they actually had a ransomware attack, and they've been dark for about a month. So that's been there. These are happening. What our role is to sort of clearly have you document the answers of the cybersecurity questionnaire. And again, we don't specifically have any concerns around the results of that.
Tyler, just for municipalities, we would ask the same questions of ourselves, would we not? Or would they be different questions?
No, the same questions, Lisa. Absolutely. So yeah, so Mission Square is just the record keeper that we asked the same exact questions that we would ask to corporate fidelity retirement plan. So
And just
yeah.
like, I mean, like a municipality, that's a good checklist for our municipality as well, who also.
Oh, absolutely. Absolutely.
Lee, could we get an update on sort of status on where we are with that? It's before the budget process, just to make sure we're on track and that we have resources appropriately allocated. I don't know if Lee is there.
Lisa, you're talking about the review of this.
The best practices, like, do we have a formal, well-documented cyber program just for a municipality?
Yeah, no, absolutely. So feel free to utilize the questionnaire we've provided. What we've seen, Lisa, on the corporate end, sort of larger corporate plans, is they may have an internal cyber team that wants to just have a quick conversation with the internal cyber team of that particular record keeper. So we're happy to facilitate that if you're going in that direction. Again, the questionnaire is pretty extensive as well, so you can utilize that. And sometimes just having that and having that sent to the cybersecurity team is enough, but we're happy to help as you see fit.
Thank you. I appreciate that. And that might be something to discuss in executive session as well,
Yeah.
to the extent there are vulnerabilities there. All right. Thank you.
Yeah, and it's really a three-legged stool with respect to cybersecurity. It's the town providing data, it's Mission Square holding the data, and it's also the employee. And what we've been pushing with Mission Square is education around how employees can protect themselves as well. Will someone be made whole if they were completely at fault for that fraud, right? Like if someone receives a fraudulent call from someone and then provides their password and all the identifiable information that they would need to get in there. But the interesting thing about this, Lisa, over the last really 5 years around cybersecurity is this is typically the largest pool of assets that most people have, and it's the least checked. So I could tell you that my wife went to Dunkin' Donuts yesterday, but some people can't, assets could be stolen and wouldn't know for 6 months. So it's definitely, people are very aware of this and the record keepers are putting more and more money, investing more and more money into their cybersecurity program. So the only other thing from a governance standpoint is, how do employees get engagement? There's really three parts to that. One is just broad education. There's a lot of educational tools on the Mission Square website. There's obviously, webinars, et cetera. You do offer specific advice. Advice is really just point in time. So you meet with someone one-on-one and they tell you, okay, here's what you should be saving. Here's how you should invest specifically. And then managed accounts is another thing that you offer, again, for a fee through Mission Square, not through us, but it's a direct through Mission Square and Morningstar, where you're really getting ongoing advice, right? So it's truly, you provide additional information around, risk profile, outside assets, et cetera. And you're managed on an ongoing basis until you elect to not be a part of that service. And so we are seeing more and more plans move in the managed account direction. You can see upmarket, roughly 81% of large plans offer managed accounts, and it's 41% of the survey here are offering managed accounts. You do offer that as a service. Again, think of it like, target date funds work for a lot of people, and what's reflected here in the green circle is where a target date fund is from an equity to age standpoint, but it treats everyone the same in that particular age, whereas managed accounts can slide up and down that equity range, that risk range based on a lot of other variables. So you do offer it. We did include a slide around the managed account tool. So you utilize Morningstar. It's not a proprietary service. It's a portable service. We are still very comfortable with the Morningstar tool. You get an idea of sort of the AUM, number of plans that Morningstar utilizes. And again, it's not proprietary to Mission Square and can be offered through 22 different other variable record keeping platforms. When we get into balances, I apologize if this is on, actually go back to the other deck here. So balances on page 81 for the 457 approaching about 15 million or so. Bulk of the assets still in that plus fund, but then the S&P 500, and then of course the target date funds. Those are sort of the top 3 funds, which you asked me about other plans. The top 3 funds are typically a protection of principal, target date fund, and the S&P. A little bit more here in the plus fund. I think that's just legacy. Years ago, people have kept their money in more of a stable vehicle, but typically I'm seeing more in the target date funds now, but no significant concerns there. With the Board of Ed plan, you can see up to about 1.3 million, and then the 401A up to about 1.1 or so. I do, because of how unique the target date funds are, every quarter I will include a slide that looks like this. Again, you offer the T. Rowe Price target date funds. You can see what the glide path looks like here. So the glide path is just the decrease in stocks and increase in bonds over time. And glide paths are different for every manager. And then you can see the building blocks of those target date funds to the right here. The only thing of note, and we speak with Wyatt a fair amount around his allocation. The only thing of note, over the last 12 months, they did increase their equity position about 5%. They were already in the high side, so that they were already sort of higher in equity, higher in stocks prior to that, but they did increase the glide path by about 5% that occurred over the last 12 to 18 months or so. The rationale behind that, because a lot of data goes into building these out. And when they originally built the target date funds in 2002, the mortality table shifted. So by 2 years, actually. So people are living longer. So therefore, you have that longevity issue to account for. So that's why you're increasing that equity position. They also realized that people weren't moving in and out of the markets in times of volatility. So if people were moving out of the target date funds, if they saw a decrease in their accounts, it would defeat the purpose of a target date fund. And they saw that behavior, people tend to stay put. And then their original assumption was a savings rate for most employees of about 15%. And the reality, this is across the industry, not specific to Simsbury. The reality was closer to 12.5. So there was an underfundedness that they were concerned with. So therefore, they increased that equity position by about 5% across the board. When we get into performance, you could see lowest cost.
I'm sorry, could I just add something? I'm involved with a different fund, and we've discovered over the course of the last year that a lot of participants were over-invested in the stable value fund. Some of them had all their assets in stable value, and now they're very unhappy because of the performance of the stable value funds over the last year. And there's been a huge exodus, which is putting pressure on the fund. Have you seen anything like that in our clients?
No, and not with the plus fund, Bert. But you do have a large, and that's been the case with a lot of the municipalities I work with. There is a bigger portion in the stable value vehicle than I typically see in, say, corporates or I say educational institutions typically like those stable value vehicles, but yeah, the municipalities have been hovering around that 20% mark. I don't see it as sort of a run at the bank, so to speak, with Mission Square, the plus fund. And when we spent a little time last quarter talking about the makeup of that vehicle, but yeah, no concerns with the plus vehicle. And actually, we also aren't seeing the shift here. as much. People kind of are staying put for the most part. You see 3.5 in December, you're seeing similar numbers, September, so you're not seeing as much outflows, but something of note. A big portion here, right? So 43% of the assets in the Board of Ed. And again, we could take a little deeper dive into, is that one or two folks, or is that a lot of individuals investing there? But you do see a big portion of the Board of Ed plan in that plus fund.
Thank you.
Performance for the target date funds has been very positive. So no concerns with the T. Rowe Price target date funds. Again, the 10-year numbers speak for themselves with respect to the overall performance. I'll touch on a few things. Western Asset, I think, Chris, we have that in the pension side. The 10-year numbers still performing very well, a little bit longer in duration, which hurt the year-to-date numbers. But still on maintain with our internal investment committee. I'll touch on one manager here. Growth stock. We've been having conversations with Joe Fath over in Baltimore. There's been obviously some struggles in T. Rowe Price from a growth standpoint. A lot of coming off of a year or two with a big run up in growth and a few names. All depending on what of the bigger names you own really impacted that longer performance. But I think our patience has been has helped a little bit over the next 2 months into the fourth quarter. That continues to outperform, as you can see, the more near-term numbers. And I think looking at it now, it's up about 44% year to date as of the end of November. So no recommendations to change. We still have that fund on maintain. The rest of the portfolio is performing as expected. Again, the index funds are tracking the index. Active managers are adding that longer term value that we're looking for. So I'll pause there. Any questions around performance, statuses, or any in the governance calendar? All right, I'll pass it back. I'm looking at the agenda, Bert. I don't think there's any other items. You're on mute.
All right, thank you very much. You're right. The last item on the agenda before I move to it, does anyone have any new business to discuss? Hearing none, may I have a motion to adjourn?
I'll move that.
Really? No one's seconding a motion to
I'll
adjourn?
second.
Okay, well, thank you very much to the folks from Fiducian, and all in favor of adjournment, say aye.
Aye.
All opposed? The motion carries. This meeting is adjourned.